In this next example, we look at lump sums from employers. Now guys, remember, if you get a lump sum from your employer, it is either a severance benefit, in which case you treat it as a retirement lump sum, or it is not a severance benefit, and then you just include it under normal tax. Right. When is it a severance benefit? If you get it from your employer because you are changing employment. Now remember, that can mean you've got a new position or anything like that, you've lost your job, whatever the case might be, plus you are 55 years old, or it was due to illness or death, or retrenchment. Right. In those cases, it's a severance benefit. So let's see in this case. So example 1, Mr. A worked for A Limited until 30 November. He was entitled to a salary of 70,000 rands a month. At the end of the year, he left the employment of A Limited, and A Limited gave him 300,000. So is that 300,000 a severance benefit? So one is, what will happen if he is 30 years old when he resigned? That is not a severance benefit. So let's look at part A first. Right, guys, so the salary is going to be the same. Look at part A, because it is not a severance benefit, look at where that 300,000 rand sits. It sits with all of his normal income, so you calculate normal tax. Look at part B now. He was 55 years old when he resigned. In this case, it is a severance benefit. So compare part A and part B. So part B, salary, 630,000 rands. Lump sum from employer, see, it's null, because under your lump sums, you tax it there. Now, because this is a retirement lump sum, right, the first 500,000 is tax-free. We receive 300,000 rands, that is why it's tax-free. Now, guys, C, they tell you he was injured at work, he could no longer work. He resigned because of the injury. It's also a severance benefit. D, he was retrenched, also a severance benefit. So B, C, and D, they all look the same. So the big difference is it moves from the lump sum from the employer, it moves it from the normal tax to the lump sum.